Sherry, let me give you some advice. Oh my God, Remify. We can ping me. I saw you come in on LinkedIn or something. Yeah. Did I accept it or not? I said, let's go. I don't know. He does it.
It's actually a group.
You put big plastic around stuff. Might have work. I'm going to have to use it. I just want to help Sherry out before he's about to pitch first. So obviously money is too much. They should have taken $1 million build the right technology. And therefore, say it's directly the same. So, and 750K would have worked 20% of the money. So if I had started this company properly, the money should be 20% of the company right now, not me. He is effectively a founding CEO. Plus, some of the founders are gone already. Did they invest? But they're all gone already. Here's what you do then, you're totally recapitalizing. And you end up having the money on and this next round.
And he said it is small. If you want to try, I mean,
I think if you raise $5 or $6 million, you're going to be in the market. You have to raise a lot of money. Can't you sell in a world off online? Tiger Text did. They never had an enterprise. Sure, the issue is you've got a cap table somebody can invest in a bank. In other words, if somebody gave you $5 million, but you're making it hard for them to give you the structure. They have to go through the hard. They got to be the asshole. So you're better off. What do you think about this? Mr. Brand. John's chair.
Okay, great.
Actually, just on the YC, I do. Why don't you sit down with YC and got a terrific opportunity. Just can't think of it. See if they'll be the bad guy.
Welcome everybody. Welcome to Founders Floor. How was dinner? Was it good? Yeah. Good. Excellent. Excellent. So we go back and forth. We have Mediterranean. We'll have pasta. So we want to switch it up. So my name is Matt Day. I'm managing director of Founders Floor, and this is our Fireside Chat networking event. This is an event that we have every. We're starting to have it every month here. So this is an event that we do in conjunction and in partnership with a good partner of ours in Procopio Law, and Roger over here heads up the Procopio Law office in Silicon Valley. And so this is an event that we, the ultimate goal is for you guys to be able to get a lot of good info from our speaker, to be able to learn a couple new things, to be able to apply that to your own startup, to be able to network with others, to be able to increase your connections with folks in the startup community, and to be able to be inspired and encouraged to be the best entrepreneur you can be. So we have another good speaker tonight, and before we get to that though, which I know that's why you're all here, I wanted to talk a little bit about our sponsors. We have a couple sponsors. I will talk first since I'm holding the mic, and then we'll kind of go and talk about some of ours. Sponsors that have tables down the road. Founders Floor. I don't know, we have a lot of familiar faces here, but we have a lot of new faces too. So for those of you who do not know, Founders Floor is a co-working accelerator for startups and entrepreneurs. We provide a startup ecosystem to help tech startups just like yourself build your business, accelerate your growth. Ultimately, we're trying to increase your probability for success. And so we do that by providing three main services to our members. First is a complete office environment. Everything you need in an office environment is here, part of that membership. Desk chairs, high-speed internet. We have a 1 gigabit per second internet connection, which is pretty darn fast. And then what we do is we layer strategic partnerships on top of that. So all of our strategic partners provide free services to our members. So examples of those free services would be Amazon and AWS. Most of our members qualify to receive $5,000 worth of AWS credits as part of the membership. Free credit card processing and brain-free PayPal, Salesforce.com for enterprise CRM, along with Force.com platform and a handful of others. You add it all up, it's about $10,000 to $15,000 worth of just free services to be a member here. So, and then lastly is funding opportunities. So when our startup members are ready to raise a seed round of funding, and it's a company we'd like to work more closely with is Founders Floor, we help introduce them to angel investors along with VCs who invest in the seed stage, and then we ourselves as Founders Floor also invest in the seed stage as well. So I think it's one of those things where it's not really a service, but it's half the reason why a lot of our members enjoy being at Founders Floor is that entrepreneurial community, being able to work along with the like-minded entrepreneurs like ourselves and bounce ideas off each other, and just that energy that we all have right here. So one of the, and then we have a couple of sponsors over here. Long, would you like to come up and chat a little bit about ophthalmology?
Good evening. Good to see you guys. My name is Long, and I'm with Ophthalmology. We are a local full-service mobile app shop. We've been around 5 years, done about 500 apps. Our customers include small restaurants, HP, Shutter Health, etc. I myself have been in the Bay Area about 20 years. A couple of things that's unique is I also invest in apps. So actually I invest in people like yourself. So if you're local, I'm more than happy to buy you a cup of coffee, share some ideas that I'm working on with partners like yourself, and share with you what's working, some of the challenges you'll face, and more of a real live setting. And what I mean that is I can share with you the experiences some of my partners are going through. So that's what we do. I'll pass my cards around, so if you have an idea, I'd love to talk with you about it. Thank you.
There are people watching it on live stream, so if you want to give folks your information there as well, they're LA, New York, Boston.
Oh, okay, that's excellent. Again, the name of the company is Ophthalmology, and my first name is Long, L-O-N-G. Just go to our website. It's short for Application Technology. So just look us up, find me, and I'm more than happy to talk to you. Even I've got customers in Australia and Vietnam, all over the world. Thank you.
Thanks, Long. Thank you. And then Ferris, you want to come and say a couple things? Ferris is a Founders Floor member.
Good evening, everyone. So I'm Ferris, CEO and co-founder of Cube Scientific, and we just built and released PriceWarm as an open beta. So if you've ever gone to the grocery store overspent by $10, $20, but still got home and forgot the milk, then PriceSwarm is for you. It's a smart grocery assistant that learns your shopping habits. And once it learns enough about you, it figures out what you need, when you need it, and where the best place to get it is. Ultimately to save you time and money. So we're running in an open beta, so I'd love if you guys check it out, give us feedback. So if you're interested in saving on your grocery bill without ever clipping coupons, check out PriceSwarm. So it's PriceSwarm.com, and we're on the App Store and available on Android.
Thanks, Ferris. Joel? Joel is another Founder Floor member with EquipMe.
Hello everyone, my name is Joel. I'm the founder and CEO of EquipMe. It's an online platform sharing the sharing economy from business to business and peer-to-peer. We're focusing on construction companies sharing equipment that they can put in the pickup truck and make money from their equipment they have idle instead of renting it out. And also going into peer-to-peer, allowing people to make memories by sharing their outdoor equipment with people in their community and save money in the process. Our website is equipme.io. Again, my name is Joel. Thanks.
Thanks, Joel. Would Betsy like to say anything? That's okay. Luke, how about with Fresh Alley? Another Founders Floor member. Fresh Alley is a company that catered our event tonight.
Hey everyone, my name is Luke Arella. I'm the Director of Sales and Marketing for Fresh Alley, and we're a fresh food delivery startup. What we're trying to do is make fresh and healthy food more accessible, affordable, and inspirational for the Bay Area. We know that everyone here is excited about going green, going healthy, going organic, so we want to facilitate that for companies who want to buy lunches for their employees. We do fresh fruit, specialty beverages, and corporate lunches, from anything from vegan to Thai food. Check us out at freshalley.com, and my email is lukeA@freshalley.com if you want to email me. Thanks very much.
Thanks, Luke. And lastly is Procopia Law. Procopia Law is a law firm that we use here at Founders Floor, and it's a law firm that we recommend to all of our members, and half our members already use him right now. And Roger Rappaport heads up the Silicon Valley office, and I thought I'd ask maybe Roger to come up and talk a little about Procopia and also introduce our speaker too.
All right, well, I think we're going to get to Duncan after we do the pitches. My name is Roger Rapport. I'm a lawyer at Procopia, partner, lead up the Emerging Growth and Technology Practice Group. Our office is in Menlo. We're a full-service firm, started in 1946. Sounds like a joke. A Jewish guy, a Catholic, and a Scotsman. You know, they didn't walk into a bar, but they started a law firm in 1946. So it covers all of the major practice groups: litigation, corporate, IP, full service, and lots of clients here. So thank you for coming. I think what we're going to do now is well, firstly, how y'all doing? I mean, this is where we picked a great night, right? The debate. I'm sure everybody's got it set to record. Sharks game, 3 accidents on the 101. It's like most people actually haven't even checked in yet. Was the traffic pretty bad coming down?
Yes.
Yeah. Okay. So hopefully people will make it in, and we apologize for picking probably a bad day, but you're all here, and we're going to make it a great night. So what we're going to do now is have the pitches, and I think there are some people that actually aren't here, but for those of you that are pitching, I'm not going to go down the list. Can you just raise your hands? Okay, so we've got most people here. Who'd like to go first? All right, rapid fire. Just James, before you start, we've got folks in I don't know, about 20 cities that are tuning in via live stream. So just one quick thing here, because I want to get this going before the pitches. Who all thinks that we're in a bubble? Could you raise your hands? Who doesn't think we're in a bubble? Okay. For the folks online, I'm trying to get a count here as to who thinks we're in a bubble and who doesn't. So if you could text me 858-442-2426. That's 858-442-2426. Our videographer is going to send you out my number. Text 1 for we're in a bubble. Text 2, we're not in a bubble. And then I'm going to come back to the audience here and figure out who thinks we are and who thinks we're not in a bubble. So James, let's go for it. You got 60 seconds. Matt's gonna time you.
All right. My name is James Heller, and I'm the CEO of Rapify. We are a crowdsourced ad platform that pays consumer drivers to advertise on their vehicle. We have an iOS app that allows the driver to sign up, schedule a campaign, pick the advertiser they want to be a part of, and online we have an ad platform very similar to Google AdWords that allows marketers and advertisers to create, manage, and scale advertising campaigns on consumer vehicles nationwide. We've been growing about 200% month-over-month growth since we launched in July. We're headquartered in San Diego, and we have an office up here in San Francisco. We are Rapify. We're changing the world of outdoor advertising. Thank you very much.
Thank you. Thank you.
Excellent, thanks, James. Who's next on the chopping block? I mean, next to pitch. All right, come on up.
Hello everyone. My name is Sena. We have a platform for building location analytics applications. So we have a behavior-based engine where you can take different location data from RFID, Bluetooth, Wi-Fi, 3G, 4G, LTE, and analyze it in a meaningful behavioral way so that you can get different KPIs and metrics and different applications on top of it. It's like a developer tool, so we're very much like companies like Twilio, where you build your own product on it and you commercialize it yourself. We work with large system integrators, telecoms, startups, and other technology companies who put either value-added services on top of it or who put technologies on top of it. We've had different applications from smart cities, transportation, retail, marketing, to IoT products. We're here in Sunnyvale, headquartered in Sunnyvale. It's a pure software business. It's completely device agnostic, so we do no hardware. We're in 7 countries, and we have worked with 2 telcos, one in US, one in Europe. So that's us.
Excellent, thank you. All right. Matt's brutal.
Hi there, I'm Seth Rudin. I'm the CEO and co-founder of Asteride. We are the kayak.com for taxis and limos. You can book your ride under one fare. $11 billion market in the United States, $75 billion market outside. We were named as the top 100 brilliant companies by the Entrepreneur magazine in June. We are based on safety. Everybody who drives for us has to be vetted, commercially insured, and carry commercial insurance. We have a safety feature called Insta Alert, which notifies other passengers or their family and friends of their ride status. We were named top app by Amadeus, and we are seeking additional funds to grow. We have partners, 6,500 drivers in our network. We have the former NLA president and the largest limousine company, Windy City, runs our branch in Chicago, and we're looking for others to join to our team. Thank you.
Excellent, thank you. Come on up.
Hi, I'm John Mine. I'm the VP of Sales and Business Development at Petzilla. We have a demo behind us. We solve the problem of separation anxiety for pets, mainly dogs, sometimes cats. This allows you to remotely see your pet, talk to your pet, take a picture of your pet, and most fun of all, and that's why I joined the company, throw a treat out at your pet. We're the only one that is universal in the treat we can launch. There are competitors. It wouldn't be a market if there weren't other competitors, right? We've raised $5 million through a combination of strategic investors, crowdfunding, and private investors. We've shipped over 3,000 units. We're available on Amazon, Best Buy, Bed Bath & Beyond, and we're seeking $3 million in Series A funding to fund exposure. Has anyone here ever heard of this product before? That's why we need money. Thank you.
All right. Duncan was waving his checkbook. I'm not sure if that means anything.
No, I know he ate his own dog food.
In the front here next.
All right.
3 facts that should scare the hell out of you. 1. America has the world's highest incarceration rate and is facing an overpopulation crisis in prisons. 2. An annual $80 billion plus on prisons cannot be sustained. And 3. 63% of offenders end up back in prison within 3 years of release. Why? Because rehabilitation accounts for less than 3% of funds spent on incarceration. My name is Lima, and I'm here representing the Last Star, an alternative sentence reduction and rehabilitation program customized to meet the individual needs of each offender. We are rehabilitation through technology. Our state-of-the-art technology allows us to coordinate and track offenders at low cost in a secure environment where we can effectively reduce the rate of recidivism. We are seeking $250K to complete our platform, launch an aggressive marketing campaign, and deploy a sales team. We are also looking for board members, strategic alliances, partnerships, advisors, vendors, and team members. So, what do I sell? I sell freedom.
All right, excellent. Fantastic. Who's next? All right, come on up.
Hi, my name is Daniel. I'm the CEO and founder of Hydrogenous Technologies from Germany. A reliable energy system needs a proper energy carrier. And not only in our eyes, the crude oil of the renewable energy era is hydrogen. The only problem though is that hydrogen is really difficult to store. Today's state of the art is to either compress hydrogen to very high pressures or to store it at really low temperatures. And both ways are really expensive and highly complex. Hydrogenous Technologies has developed a way of storing hydrogen chemically in an oil-like, non-toxic, non-explosive liquid. And this liquid can just be handled as easy as today's liquid fuels like crude oil, like gasoline, like diesel. And compared to the mentioned existing technologies, you can reduce the number of truck deliveries to supply hydrogen by 80%, and you can reduce costs by 75%. So I think recent market introductions and product launches like the Toyota Mirai, for example, show that the hydrogen era is actually beginning to start, and we provide the missing link for an efficient and safe transportation and storage of hydrogen. Thank you.
Excellent. On the nail. On there. Who's next? Nan, were you pitching?
My name is Nan. My company is Quantia. So what we do is we create a network capturing appliance. So this appliance fundamentally analyze the network traffic, network packets, so which will be resolved, solve the performance and security issues, the pinpoint. So we made like 600K revenue. The customer mostly is in Japan. Well-known companies, Fujitsu, Hitachi, all that. So currently we're just looking for $1 million seed funding.
Excellent, thank you. Who's next up? Anyone? Did you sign up to pitch?
I think so. I mean, I don't
Okay.
sign up.
I'll take you at your word and check you later.
If I did, I'll make it up to you.
Got the best joke on stage.
My name is Mark Burkell. I have a company called Junk Email Filter, which is a spam filtering business. I'm a one-person operation, and I've been in business for 14 years and doing well. I've processed email for about 5,000 domains for about 40,000 people. And I'm not looking for investors. I'm just kind of looking for business, that I'll give free service to startups, so that when you become $1 billion company, you remember me and, stay with me. And I also have technology to sell. So my filtering is much more advanced than most anything else out there. And if somebody's interested in buying it, I'd be interested in licensing it to you.
3, 2s, and 2 1.
The company's junkemailfilter.com.
All right, great. So without further ado, let's get to the main event here. Duncan, where are you?
Oh, you're ready to go, okay.
So let me introduce Duncan. Duncan Davidson, he's the managing partner of Bullpen Capital. In Duncan's prior life, he was an entrepreneur. Some of you may have heard of COVID Communications. Duncan was a co-founder, took it all the way IPO, $9 billion valuation. He was also a co-founder of Sky Networks? Skypilot. So Duncan has got some great experience as an entrepreneur, but my experience with Duncan has been in him investing in clients. And Bullpen is an amazing fund, but the venture partners are really amazing, great support for the entrepreneurs, and I sort of see this firsthand. Most recently, Duncan came in with a large strategic, helped put that was on a convertible debt, helped put the Series B together, really a lot of value add. So if you folks are post-seed and pre-A, really great firm. They've got, I think, 6 unicorns currently bubbling.
One of them is Fanduel. So it stays there. Anyway.
Okay.
For all you guys who like to play fantasy sports, Fanduel, not DraftKings. Just remember that.
Fanduel. All right. So the folks that are watching from cities across the country, you've got Slido to send your questions. We've got a number of questions already. What we want to really do is try and make this as interactive as possible. Duncan's got some slides he's going to go through, and then we really want a lot of audience participation, because that's, our meetups really are about audience engagement, giving folks access to people like Duncan, so you can really get your questions answered, not only about the bubble, but just also about funding in general once we kind of get through that. So without further ado, Duncan.
Good, thank you. I noticed a cool t-shirt. There are only 10 types of people in the world. Those who know binary and those who don't. That's a math joke. I got one for you. There's only 3 types of people in the world. Those who know math and those who don't. Okay. Question is, are we in a bubble? I got Donald Trump to say, we're in the greatest bubble in history or something like that. I'm going to go through this really quickly, and then I would like this to be interactive. So please pull your questions up. I saw most of you had no opinion on whether it's a bubble. That's just wrong. So I'm going to ask the question again. How many think we are in a bubble? Come on, everybody's got to vote. Okay, that's better. How many think we're not in a bubble? Okay, interesting. How many didn't vote? There's like one of you. Did you vote? Oh, you voted, okay. You voted, all right. Here we go. First of all, you probably know these very, very storied figures in venture capital. They all think we're in a bubble. Fred's actually been saying we're in a bubble since 2010. Mark Suster, for 2 years I thought, somebody told me, no, it's now for 3 years. They all think we're in a bubble. You can see that. They've been worried about the bubble. It's a weird thing because 2000's everybody's head. Everybody's really worried about a bubble. These guys think it's over already. What they're worried about is this. There's no IPOs anymore to speak of, but there's private IPOs. Look at the money that's running into basically private rounds. I can do 10 charts like this. They all have the same story. The money's flowing into big, late-stage private rounds. And all bubbles have the same shape. Do we all remember the housing bubble? We all remember that. It's a parabolic rise up and then drops. There's your parabolic rise up. So people look at that chart and go, oh my God, this is going to end and end badly. Now, the bubble is in the late stages. If you ask most people in venture, they'll say, well, the bubble's in these Series D and E and these late stage things. And you can see, this is, Series A, B, C, D. You can see as you go up the later letters, it gets more bubbly. The valuations in this case are going parabolic up. That's that parabolic curve thing. All right. I actually found out that a pride of lions, it's a blessing of unicorns. We've been blessed with unicorns. You can see the pace of unicornness is just increasing like crazy. I think probably half of us, how many wish we had a better word than unicorn for unicorns? Okay. Aileen Lee, wonderful venture person, spun out of Kleiner Perkins to do Cowboy Ventures. Great name for a venture fund. She wrote an article in 2013 where she coined the term unicorn. Unicorn is a $1 billion or higher company. And she was trying to count the number of unicorns over the prior 10 years. And at the time, she only counted 39.
Somebody else did the study and came up with 45, but it's, you know, so what? 39, 45. Now we have well over 100 in the US. And you can see most of them just happened. You've also heard of decacorns? Decacorn? 10 billion and above. Dave McClure came up with Centaur. 100 million to a billion. And Pony, which is I think 20 million. So I asked Dave, come on, are you a My Little Pony guy? So I think that's what he came from. Anyway, ponies. All right. Square is about to go public. This is a chart the Wall Street Journal said about Square going public. And this is one of the great things that we're all concerned about on the venture side about unicorns. Square is a pretty multiple unicorn. It almost got to the decacorn level. But take a look. Its peak money has dropped. Its current IPO, they're on the road right now, is beginning to price below the prior unicorn price. And this creates a really big question. When all these decacorns try to go public, will the public markets slam their price down below their prior price? And does that mean the bubble's already bursting? Is the unicorn bubble about to go down to Centaur level or Pony level? This has caused the venture community, yes, we're inventing all these new words, unicorps. I also tried once to invent unicon for a fake unicorn, but that didn't catch on. Unicorps, okay? These are well-known companies that people say, oh my God, they're not worth what they're worth. It really all started because Dropbox had late-stage investors, mutual funds, people that normally invest in public markets, did the private round in Dropbox. And they recently had to market to market, and they dropped the valuation, I think, from 10 billion to 8. So it's no longer a decacorn. And this caused a lot of anxiety and excitement in the venture world. But that got people on a unicorns watch. So these are some people. I was at a meeting and somebody said, who's going to be the next one to fail on unicorns? I actually said unicorns. I may have coined this term, I hate to say it. Evernote came up. Evernote, unicorn 3 years ago, has gone nowhere since. Do you pronounce that Theranos? Theranos? The Rainos. Theranos? Wonderful, interesting company with a wonderful female founder, but now the Wall Street Journal is just dumping all over her, trying to claim her technology is fraudulent. So now she's on the list. Flipboard, WeWork. I don't know if they're a 5 billion value or 10 billion. Do you guys all know WeWork? Sure, okay. Are they 10 billion? Do you have any idea?
7.
7, not even a decacorn. Why should I even bring them up? Okay. WeWork, renting out space to people like you. So there's a famous company in the dot-com era called Exodus. It was web hosting. And it was the last one to fall because when the dot-coms began running out of money, they never turned off their website till the very, very end, then everything fell off a cliff. So it was a multi-billion-dollar company that came down to earth. People are worried that WeWork is presuming a continuation of the unicornness of the world. Instacart, very, 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 it's like, we all went through this with Webvan. Do they have any positive gross margins? Jet, they just raised 500 million on $1 billion value. They're competing with Amazon. So it's a very low margin business. Okay, there's more. You could do this for party games. My hope is all of them go public. All our children are above average. Okay, let me get a little deeper. We all know junk bonds. Michael Milken went to jail. Do you remember junk bonds? So they're high interest rate bonds that they use to buy companies in a wonderful era of LBOs and all this. So some people, including myself, think these Series E's are the new junk bond. This is the guy now running YC, Sam Altman, a very good thinker in the business. You can read what he wrote. He says the reason why these unicorns have really high values is not because they're really worth that, but because the late-stage investors pack such wonderful protective terms that these rounds are really debt more than equity, and the valuation is artificially high. Yeah, you've heard this before. Yeah, I'm picking on you. I see it. So there's a thing in venture that I'll give you any price you want if you give me the terms I want. So if you play with really clever terms, you can have $1 billion value. But when they meet the public markets create a real value. And so a lot of people think because of that, a lot of these unicorn, decacorn valuations will come down to the real world, not this mythical world, when they hit the public markets. Now the other problem is this. There's another great Wall Street Journal thing. They love tech. IPO is a new down round. These are a series of recent IPOs, and they're all coming down to earth. And that doesn't bode well for the whole bubble story, does it? There's some other, I call them ominous similarities to 2000. By the way, any of you from the 2000 era remember it? You remember it. So Roger mentioned one company, Covid, went out in 98. I had another one that I took public in 99, Intertrust, one of my favorite companies ever. I pitched it. It was great fun. Private jets, top of the bubble. Went to a Yankees game afterwards in New York City. They got to a 9 billion market value on 1 million of trailing revenue. For a week, we were the most overvalued company in the history of the NASDAQ. We were number one. Believe me, I miss these days. These were great days back then. But what this chart tells you is, that's the percent of companies that were unprofitable going public in the height of the bubble. It's worse today. Does that make you feel good? Anybody feel good right now? Okay. There's some other things I just have to throw out. There's a lot of indicators in the stock market. You guys heard about the tallest building indicator? You have. You've heard about this. This is like a male thing, I guess. So, right when the Great Depression came, we built the Chrysler Building, the Empire State, World Trade Center. Right before this thing collapsed around 69, 70. You get the idea. The Petronas Towers, Asian flu hit. This huge building in Dubai, and the 2008 thing hit. And guess what? Salesforce is building the tallest building in San Francisco. You got it.
It's going to be the tallest building west of Chicago.
West of Chicago. So the Sears, Willis, whatever it's called, tower still beats it. Okay. This doesn't bode well. Now I have one other personal anecdote. So before we go to the next page, I'll tell you the anecdote. I'm in New York about a month ago. A good friend of mine says, you got to hear this pitch. Okay. So 2 kids pitched me, and they basically had not a very impressive idea. I said, well, who's the techie? Oh, we don't have a tech team. Okay. Do you have a demo? No, we don't have a demo. Do you have a PowerPoint? We got a PowerPoint. And so they're pitching me, and they'll probably raise money in New York right now. So this reminded me of this old Dilbert cartoon. Can you guys see this? The shoeshine boy indicator, you may remember this story. The patriarch of the Kennedy clan, Joseph Kennedy, was in Wall Street in 1929, right before the Great Crash. And he was getting his shoes shined. And the guy, the shoe shine stand's probably still there. And the shoeshine boy was saying, I got this great stock tip, you gotta go buy it. So he said, I'm a professional, I'm in the business. If a shoeshine guy is giving me stock tips, I'm getting out of the market. So he sold he said he sold everything before the crash. It's called the shoeshine buy indicator. So when 2 people with nothing pitch you on a deal and they're gonna make $1 million, they're gonna be a billionaire. These are all indications of the top. Now, great Wall Street aphorism. Have you guys heard this? Bull markets climb a wall of worry. Nobody's heard this. Bear markets, by the way, slide down a slope of hope. So, what I just went through is an incredible wall of worry. You got Fred Wilson worried since 2010, oh my God, things are getting too expensive. And all these storied VCs, it's going to end badly. It's a bubble. By the way, my impression when I hear all that and this is, it's not a bubble yet. Back in 2000, in 1999, one of the great, I won't mention her name, but one of the great VCs made a statement that went public, which is, I know I shouldn't do it, but I got to invest in this company. In other words, in a bubble, you suspend all your normal disbelief and just go willy-nilly into the craziness. When these people are saying, no, I shouldn't do it, it's a bubble, you're not in a bubble. So my indicator of the bubble is when all these people say, gosh, I really got to get back in the market. Now, it's very clear there's no bubble in the public markets for tech. This is the dot. See this? This is great. Parabolic rise up. That's a classic bubble. Parabolic rise up, falls like a rock. It makes one attempt to get back to the top, and then it falls down. I must say, when I took Intertrust public, it was October 99, which is about right here. We did a secondary offering right there at the peak of the secondary peak. And then, bloop, fell like a rock. That's what a bubble looks like. Do you see this bubble here? NASDAQ has risen, but this thing in the lower line is the PE ratio. It's not nutty. Here, it got nutty. Down here, it's not nutty. This is not a crazy bubble indicator. Here's the second thing. I try to come up with a clever headline, but here's the point. There's actually been 2 prior bubbles in tech in recent history. That's the dot-com bubble. This is the 1983 PC bubble. Yes, I was alive then, I'm sorry to say. But this is the second highest peak in the period of tech was 1983. There was a company that went public called Kentucky Fried Computers. You can look it up. They changed their name to North Star, but you get the idea. There was a company in Boulder, Colorado called NBI. Nothing but initials. It was a nutty period. And I was a young pup at the time, and I had one company that got out in June of '83 called Intertron, and a company called Digitex that couldn't get out in July of '83. The market closed like a rock around the 4th of July. Done. Had a secondary peak here, and then it was over with for a long time. We're not there yet. Look at that. We're not even close. So there's clearly no tech IPO bubble going on in the public markets. Here's my favorite slide. This was about a month old, but it hasn't gone any worse. In 1998, we had the Asian flu. Russia was going bankrupt. All kinds of bad things were occurring. And somebody overlaid the current stock market that had a big crash or a big problem over the summer with the 98 market. It's eerie, isn't it? And this market bounced recently right on time, and it kept going up. Does anybody know where the NASDAQ is today? Curious. Can somebody look it up? Because this is the NASDAQ. I think it's up in this range. Yeah, 5020 or 5200.
No, I think it's 50.
Okay, so it's right about in here, just like we expected after a little bit of a glitch. It's eerie when this happens. Now, pattern recognition doesn't mean it's going to continue. But I'm asking myself, are we actually in 1998? Now, most of you who didn't live through the bubble don't remember this, but let me show you some headlines in the Wall Street Journal in September '98 when eBay went public. You probably can't read this. eBay breaks a long, dry spell of IPOs. The IPO market's longest dry spell since 1985 may be about to come to an end. Somebody quotes here, well, eBay's success is unlikely to beckon a new batch of IPOs. Ever seen headlines that were this wrong before? Anyway, September 1998, nobody thought it was a bubble. We had a year and a half, almost no IPOs. Everybody was grumpy and morose, and this thing happened. When that thing went public and went really well in the public markets, we had 18 months of the NASDAQ going vertical. So I'm asking the question, how can a bubble burst when it hasn't happened yet? So what I'm basically arguing to everybody, happy unicorn, what I'm arguing to everybody is that the bubble is in front of us. It hasn't happened yet. Maybe Square Square's going to go public in a couple weeks. It's on a roadshow. It's going to price a little higher than the story in that chart I had. Maybe that stock goes up 50%. Little bell's going to ring. You mentioned bells ringing. Bell's going to ring. And a flood of unicorn IPOs will start spawning themselves upriver into this market. And we shall see. One other thing to comment on. We'll probably be asked this question. Roger, there's Roger. The question is, why do bubbles occur? Let me sort of preemptively answer it. Every technology in history came in with a boom or a bubble. Canals, railroads twice, cars. There was an auto bubble, Henry Ford auto bubble, 1914 to 19. Then the market crashed 72%. Everything comes in, PCs came in with a bubble. It's human nature to get irrationally exuberant and try to get onto the party. And they all crash, and then after they crash, the winners consolidate and win big. So it's just human nature. Bubbles aren't to be feared. They're something to be hoped for, actually. But they do end badly. The second thing, though, is that usually bubbles go wacky, not because of tech, but because of other forces. In 1998, the Federal Reserve flooded liquidity into the market. And then it continued because it was afraid of something called Y2K, which happened to be a fizzle. In 2000, as the bubble was peaking, the Fed pulled the cookie out of the cookie jar, raised interest rates, and pulled liquidity out. We went down. We sort of saw this with a housing bubble, right? They pumped a lot of cheap liquidity in, then they took it out at the peak of the bubble, and things crashed. So the question is, are we going to have another liquidity pump of that magnitude soon? I think we might. It's something, the story looks something like this. Global markets are really in turmoil. Money's flowing into the US, flight to quality, out of both China and Europe. The Fed might raise rates in December. I don't think it really matters, but I think you're going to see a huge flood of money coming to the US as the rest of the world slows down and begins to collapse, to escape whatever fate it has. That's our Y2K liquidity pump. And that money is going to spill over into tech stocks. So the IPO thing may open up next year just when just gobs of money came rushing into all US assets, treasury bonds, stocks, and IPOs. And then we might have a glorious year and a half, and then we all go off and either party or have a long vacation. All right, thank you. Let's get into Q&A. Roger?
All right.
Let's get some questions here.
Okay. Any questions from the audience?
Well, I have a comment about the bubble thing. What happened in the late 1990s was the beginning of the internet, the real beginning when people were just beginning to get online in a serious way and everybody could see it all coming and people were throwing money after things that were nothing, Napster, and things like that. And then it all crashed when a lot of these companies had no foundation. I think that the difference today is that companies are coming out with real value. I say that invention is the mother of necessity. They invent something and then everybody has to have one. And I think that when you have a product that actually is useful and doing something good, and because of the new platforms we have with cell phones and tablets and everybody connected, that there's a lot more reality-based solidity in the products and the companies, and that's why I think that, I agree with you that there really isn't a bubble. It's going up, but it's going up based on a more solid foundation than it did in the 90s. That's my 2 cents. I don't know what you think about that.
Well, a lot of people have made that argument. The argument is we're doing real revenues. Back then they were all fake little revenues. And yet I showed you this page, if I go back here, that should give you a little bit of a heartburn. This one. Number of IPOs that are quality or not quality. Now, of course, the quantity today is very low versus then. But why would all the crappy IPOs go out instead of the good one? The fact is, every tech bubble, PC bubble, which ended in '83, and then obviously the .com bubble, has real value being created. There was a very prescient comment made by Mayoshi Soon, who runs SoftBank. He made this around 98, 97. He said in 1987, after the PC bubble crashed, he took a lot of money and he spread it across the top 40 companies that emerged out of the crash. He made 40 times his money from 87 to 97. He made more after the bubble because the winners had emerged than before. If you go to, I did this analysis thinking how brilliant that was in about 2002. And after the .com bubble, I counted 200 companies that had emerged of huge quality that were going to become the big winners going forward. And we can see them today, Amazon being one of many examples. So I think what's going to happen after this era is there'll be some quantum of companies, maybe it's 200, maybe 5, that will have serious value like you're talking about. And over the next 10 years, they're going to be enormous wins. Okay? Just the nature of booms and busts. Yes, question in the back. Roger.
So my question is that you're probably familiar, The Economist ran an article maybe a month, 6 weeks ago on the Silicon Valley one, where they basically said what's fundamentally different this time is that who's going to take the hurt is going to be the private money and not the public market. So it might have a less systemic effect on the whole economy when it does crash. Your thoughts?
Yeah, I think that question is the most important question. Now, to some extent, there's two sides to that question. So if everybody understands the question, what happened on this era is very weird in that we did so much over-regulation after the 2000 bubble. We did Sarbanes-Oxley, we used decimalization, destroyed the small investment bank. Elliot Spitzer demonizes analysts, so the analysts were divorced from the bankers. And so mid-cap and small-cap stocks have no support in the market. So only the big dogs get out. And the implication on the negative side is this. You could have bought Amazon, I think it was 96, 97 when it went public, probably 96. It was about a 400 million market cap company. You could have bought into that as a public retail investor. What's it worth today? 250 billion? That 400 to 250 would have gone into your wallet. When Facebook went public, you're right. It didn't go public till it's worth $100 billion or 85, whatever it was. And so the small retail investor had no chance of participating in getting rich. It's like we used to democratize wealth, and the so-called solutions of after the bubble took it away from the small investor and threw it into the insiders. Evil people like me, I'm wearing black today, so, you know.
That just exacerbates the whole wealth gap, too.
Yes. So you're saying that because these big institution insiders are able to be more cautious and more careful, they won't have a bubble collapse.
No, I'm not saying that. They're the ones who take the hurt.
Yes.
More than the individual investors. Although it'll still have the same effect of drawing up investment.
Yeah, okay. I think that's true just because we haven't democratized wealth. But eventually individual investors put their money in Fidelity. I don't have a chart here, but if you look at who is actually putting money in these unicorn private IPO late rounds, it's not the venture industry. It's Fidelity. It's the people that have your mutual fund money are the ones that are putting money into these. And so you will ultimately take the hurt. But it won't be the same character. However, one more comment. People make the assumption that the retail investor is dumb money, gets too exuberant, rises Tesla to an unusually high height, it's going to rise it down. But that these sophisticated big company investors aren't like that. History says that's not true. They're equally as caught up in the excitement and equally lose money as to the individual. They just have a more sophisticated way to talk about it. Okay, next question.
We'll take one more here, and then we'll go to the audience, live audience. Go ahead, James.
So one of my questions is, you look at a lot of the companies that are being valued based on their user base, these monster user bases, and they're associating value to the quantity of users. Do you think that that era is coming to an end? Do you think that there's going to be a reconciliation or a rebound effect that happens as a result of that era coming to an end?
It's another very good question. If you look at, how many of you use Snapchat? Are we all too old? Some of you do, okay. The rest of you guys are all too old, right? Anyway, Snapchat has got a huge audience of centennials and younger millennials. Centennial, by the way, is the next thing after millennial. And they're making no money. They're worth, I don't know, 13 billion? Anybody know? 30 billion? 20 billion? Going once, going twice. Okay, let's say they're worth something like that, 20 billion. They're probably on my unicorn chart somewhere. I think they did 50 million of revenue. We'll do 50 million this year. There's no economic way you can justify 50 million revenue being worth 15 or 20 billion dollars. Unless you believe they'll monetize all these people to such a degree they'll grow like crazy, right? If you go back to 2000, the big complaint was we're valuing companies on eyeballs and they're not monetizing, and so when the musical chairs stopped, all the eyeball companies just evaporated. So the answer, I think, to your question is this. Snapchat seems to be able to rapidly monetize. They're going to have a race with the end of the bubble. Can they monetize to the point where their monetization catches up to the value before the musical chairs stop? I don't think it's that different today versus then, even though people argue it's different. In fact, The thing you should always be afraid of are the words, "this time it's different." Right? By the way, the more you hear that, the more I'm in the bubble world. Okay. People say, no, it's okay to do it. This time it's different. That's when you say, okay, I'm going to hold on to my wallet. People are starting to say that. Did that answer your question?
Yeah.
Okay. There's one back here.
Just let's get one from the virtual audience. I think this comes from New York or Seattle. What are some aspects other than high valuations that are common between now and the dot-com era that support the possibility of a bubble? That's a tough one to answer quickly and succinctly.
There's so many, I don't know where to start. The real question should be, what is different? You try to argue it's different because they're making more money, right? But no, there's a lot of companies valued on monthly active users instead of eyeballs that don't look any different, right? And so I don't think it's any different. And I think this is one of the sort of proof points. They shouldn't assume it's any different. The only real difference is we're not yet in the bubble.
So you're saying it's to come?
Oh yeah.
In terms of your best guess.
History is clear. Boom, bust. There's never boom, 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 boom.
Yeah. Okay. Well, you know, if you go on saying there's a bubble for long enough, you'll be right eventually.
Well, the other way to put it is, the other thing to think about is some people think, why can't we just grow steadily and never get there? And the answer is, that's not human nature. It just doesn't go that way. So it's going to keep growing. You may get another year or two, but you're not going to get a decade of happy, steady growth. Everything's good. Doesn't work
And
that way.
Twitter may be, Square may be the catalyst, in your opinion.
Fingers crossed. Okay.
Okay.
I'd love it if it were true. You got one of the coolest founders of the era. And I think on his video, his IPO, did you guys see his IPO video? It's out. They all wore black. It's like totally cool, doubly cool. He's got the beard. No, and Jack is actually an amazing, amazing entrepreneur. I don't mean to make fun of it at all. He is an amazing guy. And they have a really good team. All the pieces are in place. We'll see.
Question here.
I'm older than I look, so I kind of remember the dot-com boom. What I don't remember about that being a derivatives market as big as it is today could that be really what the boom or what the bubble is today, as opposed to like the public market of, you know, the NASDAQ and
By derivatives, you mean options, calls,
that kind of
all
stuff?
that kind of
I don't remember it being anywhere near as big as it is today, as it was back then.
So, tech market. So let me put it this way: do we all know the concept of creating alpha versus beta? It's sort of a stock market term. There's even a website called Seeking Alpha, kind of cool name. So beta is more of the systemic risk of the market. Are you clever at financial engineering? Alpha is, did you create real value? If you look over the whole world right now, there's no value in China. There's no value in the BRICS. Goldman Sachs said the BRICS are dead. There's no longer any value in fracking. Oil's dropping down. It's like 43 today. The only place in the whole world that's creating alpha, meaning real value and growth, not financial engineering, tech. You're sitting here in like one little peninsula up to San Francisco, which is creating more growth and value than the whole rest of the world combined. So what's interesting about that is that money's a funny thing. It flows downhill, avoids rocks, and it seeks alpha. It'll seek alpha. It'll come into the tech world. And I don't think derivatives have much to do with it, because that's a whole different problem. Now, let me say this differently. So you guys all, there's a couple of mistakes made in the 90s in regulation. One was getting rid of Glass-Steagall, and that turned Wall Street into a casino for speculation, not investing in real business. Second was decimalization, which decimated the small investment bank we used to live on. The third was they didn't regulate derivatives. They didn't put them on an exchange. And a crazy idea. And there's something, I've seen numbers as high as $600 trillion of derivative interest out there. And they all think the calls and the puts will offset. Well, it's like you're shooting a little rocket to the moon. What if you're off by 3 degrees? Okay, what is, 10 degrees? That's $60 trillion you missed. That's bigger than the whole U.S. economy, right? So it's a risk. In my thesis that this flood of money, flight to quality to the U.S. from the collapse of the rest of the world would drive liquidity as a liquidity pump into our markets, spill into tech, we have an IPO. That's the thesis. There's also a trend reversal thesis. The thing I don't know is, will the global market go into a recession in 2016? Don't know. Looking really bad. It might, and that might skew my thesis a bit. And if it did, you might have your derivatives begin to unwind in a nasty way, and that 1 or 2 or 3 degree off means you get 10 or 20 trillion dollars of disaster, which is bigger than what happened in 2008. And that would slow down my thesis. My thesis would be, though, even if that happened, the bubble would still happen. It'd just be delayed till we wash through the immediate panic. Because we create alpha. Nobody else in the world is right now.
Okay, we'll take a question. I think this one is from Austin. If we're in a bubble, what are some safety nets inherent to the ecosystem that might make the bubble burst different and less depressing than the last .com bubble burst?
Well, first of all, if you're from Austin, I hope he's a fan of Asleep at the Wheel. Just a question. It's a real band. I don't know if you guys know them, right? Asleep at the Wheel. I think we already answered that in part. The thought would be, if this thing breaks, and it isn't a panic sale of the retail investor rushing to get out, but these seasoned vets at places like Fidelity sort of hold on. Or put it differently, because so many unicorns are not liquid, you can't dump the stock. And so what happens in that case is you don't have the feeling of a total collapse, with one caveat, and it's a big caveat. So the question you should be asking me is, what advice would I give to a company to withstand the bubble correcting? Okay?
Good question.
Okay. So it's the other side of what you're saying. If you're a company that can slow down your growth and glide path to being cash flow positive, you'll survive the correction, the collapse, the bust. If you're a company that still needs gobs of money to keep growing like crazy to get to that point, you are a dead duck. Okay? Now, in the unicorn world, there are a lot of companies with negative gross margin businesses. That's not a good place to be. That require gobs of money to get to the point where their sustainable growth can pay for their overhead. Those are roadkill if there's a bust too soon. And so if my timing's right, either maybe 18 to 24 months before the correction, or if we have this trend reversal, maybe get 36 months. These companies have to think, I've got to grow fast enough with gobs of money to the point I can glide path to being positive and control my own fate, or I'm a dead duck. That's what they should be thinking. Okay? And one lesson we learned from 2000 is don't keep on raising gobs of money and growing like crazy. So people did learn that lesson. Whether they apply it is unclear.
So if you're a startup, I'm not sure how many unicorns there are here, but probably
okay, let's ask. How many unicorns?
Not that many.
We got one, okay.
So
actually, different question. How many female founders do we have here? Or at least CEOs? 1, 2, 3, 4. Well, 4.
You said at least CEOs. I thought there was a period.
Okay, you have a, okay.
So, for most of the audience members and probably folks that are tuning in as well, that may have raised some money, this seems like it may be a challenging period. So if you've raised some seed funding and you're now, proving the model, building a scalable, predictable model, you're looking for a Series A, or maybe you're looking for a Series B, what advice do you give these folks? So you have to ramp, in order to get a Series A, you have to prove traction. So you got to really, ramp up your burn. I mean, what advice do you give to, the folks out here that aren't unicorns?
Because of the fear that the bubble's going to burst, because of this wall of worry, a lot of venture investors have been shifting away from growth to unit economics. And whether they're right, and not everybody, there's some contrarians that are still trying to go growth. But basically, you're better off if you really have a solid economic story in your company and they think they're investing in a sustainable company as opposed to, I got to grow very fast and I'll monetize later. So in other words, a lot of the consumer apps that used to be well funded are having a more difficult time getting through the gates. The bar is much higher and the metrics to get funding are different. But those with good unit economics that are still growing well are quite fundable right now.
Are you seeing, there's been a number of later stage VCs that have basically said, they're putting the pencil down. Have you found that with any of your portfolio companies in the later stages that there's been some pullback from later stage investors?
No, I've seen a different phenomenon. It's kind of interesting you put it that way. Let me attempt to be colorful. I know I'm pretty bland sometimes. Colorful. What's happening in the venture markets is the hedge funds, PE firms, mutual funds, I'll call them Huns because they start with an H, Huns. The Huns are coming down, down, down. They used to only do $1 billion and up. We had one of the Huns do a round for one of our companies that was in the low 100 millions. Now then the next set of investors below these people and above venture are the growth funds. They just call them GOS, to be colorful, it starts with a G. So these Huns are putting pressure on the GOS, and the GOS would normally do the 100 million to 500 million rounds. They're getting pushed down into the venture, into the empire of venture capital. And they're actually, I've seen GOS come down to 40 pre-type of rounds. And that's been interesting, because that puts pressure on the normal venture fund, which if they don't behave quickly enough and act quickly enough, the GOS steal the deal. So I've actually, the people that are saying they put the pencil down, maybe, I've seen a lot of venture funds actually quicken the pace to avoid getting preempted by Huns coming down to GOS and GOS coming down to the VCs.
Wow, the landscape is definitely changing, kind of the way super angels change it for VCs.
That's correct, change at their end. Other questions?
Oh, let's give somebody else here.
So the number of users using cell phones and computer has increased to what it was in '99, and basically at that time the consumers are only focusing in the United States. Right now we're seeing a lot of technology boom in other countries like India, China, and other third world countries. So don't you think that that has enhanced the base of technology? Even a family of 4 would have like 5 to 6 devices, as compared to what it was in '99. There were like 1 or 2 devices per family. Like you have to have a computer, that's it. There's nothing beyond it. So wouldn't that affect the what the growth we're seeing? Wouldn't that complement it?
It has affected it in a very profound way. Almost all the profit of the mobile industry goes to one company. I'm one of the cult boys. I got a watch on, I got an iPad, I got an iPhone. It's an amazing phenomenon. But the cell phone business is still growing, but it's growing at the low end, and so it's no longer the heyday of rapid growth of mobile. I mean, Apple almost got to $1 trillion market cap, because mobile's an amazing thing. Facebook, we're up to 300 billion market cap, and they're doing an incredibly good job of getting out to the emerging markets. And they're fighting over these very people because they're trying to do much more than just make immediate money. They're looking at the long term. How can they bring these people into the modern world, and how can they serve them? You got to step back in total amazement and just wonder at how well this is working out. I do. But stock markets are not rational. In fact, the statement that Keynes made is markets can stay irrational longer than you can stay solvent. What he meant by that is a stock market will drive up the price of a Tesla way beyond its current value, or Snapchat. In anticipation, downstream it'll catch up. And so what happens in these businesses, it happened in the '83 PC bubble, happened in the dot-com bubble. The values got way out of hand, but the real companies emerged out of the bursting of the bubble. And as Sun Tzu found, he made 40 times as money in the 10 years after the bubble than during the bubble. Same thing will happen here. The companies that get through this are going to become enormous, powerful companies over the next 10 or 15 years. And they're going to do what you're talking about. But the stock market's not going to wait for them. You get my point? Okay.
A question from the virtual audience. When there's a bubble, which areas do you think will be hit hardest?
When the bubble bursts?
Yeah.
Is this a question geographically? Metaphysically? Existentially?
Existentially. Are there any areas, yeah.
What happened in 2000 was the dot-com bubble burst first, March, April. The telecom bubble didn't burst till September, October. So it was kind of like a rolling bubbles. I put this chart up just to tell you, bubbles happen in a micro and a macro way. I'm saying the big one hasn't happened. It's like the big earthquake hasn't happened. Doesn't mean there haven't been other things. Seed was in a very, very incredible bubble. And you can see here, this is like seed funding rounds peaked and has dropped very rapidly. So in effect, you could say the seed bubble already burst a year ago. Did you guys all miss it? Already burst. Here's another view of the same chart on a quarterly basis. The parabolic rise and then the drop is pretty vivid, I would think, right? And the era of angels has closed. Now, I did a blog post on this. It was kind of very wistful. I felt like it's the elves were leaving Middle Earth. The angels are... What I mean, you can see the angel seed dollars are dropping, but a lot of angels became seed funds. They institutionalized, and their behavior changed. And so they did bigger rounds and fewer of them, and the whole character of this business has actually changed in the last year and a half. It's not been widely recognized. AngelList, you can see this thing has fallen off. You have a question, I think, for me about crowdfunding, but you can see how it's fallen off as well. So what happens when this has already happened, the bubble exuberance in angel and seed has already changed pretty seriously, gone to a more mature, different stage. And just like I said with the 83 or the 2000 thing, the super angels and seed fund winners are beginning to emerge out of a murk of a lot of them. Just like, you know, the winners emerged out of the other bubbles. So this market's already becoming more consolidated. That's the only part. Do you think the question is more to it than just this type of microcosm?
I guess the individual's really looking to see if there are certain sectors that are going to be hit harder.
Well, as I was saying,
Yeah.
consumer seems to have had its own little heyday, and it's getting rarer and rarer to rarer. And Snapchat was kind of out of the blue, is great. Yik Yak may make it, who knows. But there's been things that have come along that have popped, and there's fewer and fewer. If we did a unicorn, like a blessing of unicorns, we did whatever it was, a pride of consumer, you would find that it was very, very dense for a while, and it's thinning out. So that's already past its heyday, and the winners are consolidating. SaaS may be getting near that point. If SaaS advocates say, oh, no, SaaS is going to go on forever. I don't know. Some of these big companies have 40 different subscriptions to little SaaS products. They can't deal with it. So what's going to happen is SaaS will begin to consolidate up like enterprise software did back in the 90s. So SaaS may already be... But I think what's still in front of us. So if I was going to recommend everybody think about the future, it's the following. What makes this era of computing fantastic, it actually gets back to what was said in the back. What makes it fantastic, so in the 80s it was engineers selling to engineers. For the female entrepreneurs it was dudes to dudes, right? How boring is that? In the dot-com era it was a lot of enterprise software or networking sold to networking dudes. Very boring. This era though is technology is now eating real businesses, not just tech to tech. It's not just IBM at risk. Right? It's taxis with Airbnb and hotels, Airbnb and Uber. We're actually now invading real markets in the real world. There's a whole world out there of these markets, and they've been barely tapped so far. Just a few have done. And this is global, not just local. So if I was going to make a recommendation, start thinking about how you can use technology to totally upend and change real businesses as opposed to tech businesses. I think that's going to persist. I think if we look back in about 10 or 12 years, we're going to go, wow, that really was an amazing wave across the whole world, more than the next SaaS product sold to a boring enterprise company.
Go ahead.
Yeah, Duncan, what's your opinion of the SEC Regulation A+ that's been approved recently?
Reg A's been around for a long time, so I don't know if you guys know Reg A. Yeah, I know. Reg A was a creation a long time ago of a simple IPO process. You have to register, but it's not anything like a real IPO. The limit used to be $5 million. And back in 1945, that was a lot of money. It's worth $50 million. Now it's all, and now the limit Reg A plus is $50 million?
20 million or 50 million.
Okay. So for those who don't know, Reg A plus lets you do a little tiny simplified prospectus, file it with no review in the SEC, and sell your stock to widows and orphans. Okay?
Non-accredited investors.
Yeah, non-accredited investors. Now, personally, good thing, my point of view. Democratization of wealth, let everybody play in this party. There'll be money lost, there'll be money gained. I think it's a good thing. Here's my issue. They took so long. When was the Jobs Act passed? 2009? That's like a whole generation ago, you know? Think about this. They should have been out here. This is only a few, you know. I wish they got the regs out 5 years ago and the institutions could have been created. I am worried. I would love it if it worked. I am worried that this change in the angel industry is not going to be changed by crowdfunding. I'm just worried. But I've seen some people do Reg A deals. I saw a Reg A deal come out of Hawaii, raised $5 million, IPO. It went from, got it to like
Is
seven.
Reg A the same thing as Party Road?
No. Just a simplified filing. It's like, you know, the government taking it away and giving it back. So they took away the mid-cap small IPO when they got rid of decimalization, which you can read about. They blew up the small investment banks. They made it onerous to go public in the real world. And Reg A Plus restores a small offering. So I saw this one offering go, and it went out and it got up to like 700 million market value. It's dropped down to maybe 300 million. Here's what the problem is. There's no institutional support for it. So you put it on the marketplace, you don't have any analysts, you don't have a lot of support market makers, and it sort of becomes a semi-liquid stock.
Is it exchange on any?
This might have gotten exchanged, I'm not sure. It might have gotten valued to be an exchange. But if nobody cares, nobody cares. So you end up with this phenomenon where these stocks get to be orphans, and nobody trades them, and it's hard to revitalize interest in them. We used to tell people, don't go public in these small exchanges like London or Japan or Australia. It's like a roach motel. You can check in, you can't check out. Because if your stock falls off, nobody cares, you can't raise any more money. You're from New York, you get that joke, right?
Yeah.
Anyway,
And, you know, the
but
problem-
I really do hope Reg A Plus works. You can see my concerns. There's a lot more to create a system than just one regulation. And the other pieces may not be in place for it, like market makers, real market support, and so forth.
Yeah, you know, I've got a couple of clients that are in that valley of death, public but unable to raise funds in the public market, and you can't raise them in the private market either, so it's tough. Got a question over here.
Thanks for the talk, actually, it was very useful and informative. I have a two-part question. So one, basically trying to intentionally think away from what you're thinking, actually, or basically trying to think it's not a bubble. And another one, basically agreeing with you wholeheartedly it's a bubble and trying to learn from your experience or prediction, actually. So the first part is basically like trying to say that the world wants to invest in entrepreneurship and new things are coming up, like new businesses rather than new technology, actually. Like completely new things that change the world, and there's only one spot to do it or one way to do it, so maybe that's why everything is going up. Like Google comes up with new things and then it keeps on growing for a very long time than people predicted, actually. So the bubble will still continue for some more time and then die, so that's one part of the thinking, actually. And the second part is basically totally agreeing with you and saying, hey, how long will this last, actually? Like, will all the investments go away and all of us have to basically find out new jobs and stuff, being entrepreneurial and everything, so that's two things. Yeah.
Well, first of all, if you look at the U.S., in fact the whole world, new business starts, small business, there's a debate tonight. They probably said small business 50 times. I love small business. New business starts in the U.S. are the lowest they've been in anybody's memory, and they're getting lower, lower, lower. New business failures are higher than new business starts. We're actually eating into and destroying our small business base. This is economic death for an economy. It just is a suicide. So a lot of reasons why it's occurring, I don't want to go through them, but I really strongly believe in startup culture. Paul Graham said it great, which is, in the old days, you go to college and you have two choices, get a job, go to grad school. You probably had a third choice, go to law school, but nobody should go to law school. But he said, let's create a new third choice. Get a job, go to grad school, or start a company. And YC was founded on that principle. This, Silicon Valley, forget tech and engineers and all that, if we could somehow take this startup culture idea around the world, or around the country, to Detroit, for God's sake, you would create more value in this country and the world than tech startups. They'd be spread and diffused, and it wouldn't be venture back, but it would change so many people's lives. I've actually been trying to get involved with this here or there and trying to do what I can. I really believe in this. And the one thing I'm really worried about, I'm not really worried about stuff like this. There's other ways. Capital will find a way. It may not be crowdfunding, Reg A+. It'll find a way. What I'm worried about is that if the bubble bursts, it kills startup culture. We're starting to get this thing going worldwide. It's a spreading of entrepreneurship, risk, this whole thought you can run a company. We're spreading it worldwide. I hate for that to get killed by the end of the bubble. That's actually my biggest worry. Second side of your question. If I was going to give advice to anybody, you didn't really ask me this, I was going to give you advice. If you go back to the 83 thing I talked about, okay, maybe your no-name computer company never went public, but the opportunities kept growing for you, and you could position yourself in 94 to go join Netscape. I had a lot of friends at Apple, and they sort of, in a mob, rolled over to Netscape, and they caught that craze. And so, people today doing your startups, let's say you don't get funded, or you do get funded, and you get caught up in the bubble, and oh my God, don't worry about it. You're here not for a startup, but a career. There's going to be another one after this. We pretty well know some of the contours of it. You probably all know this, you know, robotics, cognitive computing, AI, all these things are going to take all our jobs away. We keep going. 3D printing, right? Self-driving cars, drones, all this crazy stuff. It may not get fully mature in this era, this bubble, but it will in the next one, plus other things. And it's going to come. Just think about 3D printing. Imagine somebody's trying to 3D print a car. So right now, the way the world works is the Chinese mine raw materials out of Australia. Just huge amounts of iron and coal. Ship it up to China, and they build iPhones, and they ship it to us into Europe. Now, so you have this whole global flow that way. What if you could 3D print this down the street? And suddenly, you don't take raw materials out of Australia, put them in China, ship them over here. You take sort of cool, refined metals and things out of Australia, they go up the value chain. You ship them all over the world, and that gets printed down the block. The total structure of global commerce will invert. The supply chain will simply invert. It'll be one of the greatest disruptions in a long, long time. Now, for people that want to be startup culture techies, you know, it's kind of fun to go after the taxis. Nobody likes taxi drivers and take them down like Uber did. And you can see them fighting back with government regulation. It's kind of a fun thing. How cool is this? What if you could take down the whole global supply chain? That's something to aspire to. I think you should all think. I think we should all think about it. You're here to make a career in startup culture. And you're here to learn skills and get talent. And even if your startup doesn't work, keep going. Because when the next wave occurs, I think this wave is pretty big. If the PC era was like 40 good companies and the .com was 200, this might be 1,000. The next one might be 5,000. Glorious moment. So you might go through the bad times and it comes back again. Just keep that in your mind. That's what you should be aspiring to. Take down the global supply chain and have a lot of fun.
Great. Yes.
Duncan, that was a great answer. My question is past the seed, you're making a pitch to a Series A investor. How much emphasis do you put on IPO, or should the emphasis be on the B and C round?
I did 4 startups, and I had to go pitch the normal Series A back in the normal Series A days. It's kind of funny. Totally changed today. So what I'd recommend you're focused on is, now I see a lot of pitches, people ask me for advice, good, bad pitch. So just think of it this way, the pitch is full of concept, you're not going to get funding. If you got a real company, you're not going to talk concept, you can talk results. What you should be thinking about at the Series A or B level is, what are my results? What's my business structure? What milestone do I achieve on the money? That's the pitch. The pitch isn't, this is a really cool idea, here's my product, here's all this technology I put into it. No, that's not the right pitch anymore. So my recommendation to people is, do a pitch which looks like a real company that needs money to fix the sales model, keep growing, etc. See what I'm getting at? And don't think getting to a B if you get the A is the goal. That's not the goal. We have people come into us, so Bullpen, you do post-seed, I want to bridge to an A. And I say, that's very interesting. Most bridges I find are peers. They go halfway out in the lake, straight in the water. Get out of here. I don't want to do a bridge. And then they say, what's your milestone with this money? I want to get the A round. I say, well, good luck. Hope you find the A round. That's not a milestone. That's a result. A milestone might be, I get 100 million monthly actives, right? I prove out my business model. I'm growing 4x year on year, and I'm going to get to a 250 ARR. Those are milestones. They're real. They're getting an A is a consequence. It's not the goal. So get your head around the reality of your business, how much money to get to the next level, and make the next level not more money. You got it?
There was a question about crowdfunding, and I know we kind of touched on this, but what are your thoughts on crowdfunding and how that may be impacted when the bubble bursts, and what does that really mean for innovation?
Well, first of all, I think Naval and AngelList, marvelous innovation. I celebrate the innovators in finance. So Paul Graham, YC, incredible innovation. Josh Koppelman, first round capital, great innovation. I love that. So Naval and AngelList, fantastic innovation. It'll continue. It'll continue. I don't think it goes away. My worry is this. He's trying to make this a very fundamental thing. He's actually trying, if you think about it, he's not really trying to go after VC, he's trying to go after angels. He's trying to systemize the angel market and become one of the greatest angel systems out there. I hope he pulls it off. My worry about this is, when the bubble ends, the desire to play the innovative game will diminish. Innovation thrives during a bubble. After the bubble, everybody goes, well, I told you that idea wouldn't work, and you get this inertia that slows you down. So I think Naval Kickstarter may have gone past, remember I said you get to a point where you can be sustainable? These guys may be past that point. I hope they are, and they'll sustain. A lot of others probably won't.
Hi, thanks for the presentation, very interesting. Thinking a little bit more tactically, given that many of us are here and we're looking at the scenario, what would a strategy be to beat out your competitor? If you were out looking for seed funding, what would you do? Kind of hard question.
Well, let me give you it's sort of a broad question. How do you raise money at seed and beat the competitor? And I'll give you a very unsatisfying answer, but I think it's the right answer. I see a lot of deals flow through, and they claim to be different. And the difference is minor. You got a red VC, not a green one. But you can get more sophisticated than that, but the differences are not major. Then I ask them a question. Okay, what is your sustainable competitive advantage? What actually creates a monopoly? What actually gets you to a point where you can grow like crazy and they can't catch you? And they don't have an answer because they're not thinking that way. So a lot of the seed companies are incremental improvements of what exists, not fundamental improvements. So I tell people, get fundamental, do something profound and different. It's harder to raise money, actually. It's actually very funny. You would think, better mousetrap, you all get some money. It's not the way the world works. There's a lot of better mousetraps, never get any money. Most venture people, see, man is a herd animal. Right? We're all sheep at some level. And so venture people tend to do what the venture people do. So all the time in venture you see one idea gets funded and there's 10 others of minor derivation difference because they got a better team or a better this. Not fundamental. What you should be trying to do is do something where you are the one in a market. Now being the one is very, very risky. Let me give you I'll give you some aphorisms like wall of worry and all that. Do you guys know the 3 rules of real estate? Everybody know those rules? Okay, somebody, what are they?
Location.
Okay, what are the 4 rules of venture capital? What is it? No, it's too early, too early, too early, too late. Often, if you have a unique idea, you're too early. So it's a combination of getting the right timing and having a big enough competitive advantage and distinction that if you hit it, you're going to grow like crazy. A good example, very, very old and used, but a good example is Facebook. So my prior venture fund was in MySpace, and at one time was a great company. My partner in the venture fund was in Tribe Networks, you probably don't remember, but LinkedIn, Tribe, and Friendster were the first 3 of the modern social networks. And LinkedIn got through, the other 2 didn't. I think Facebook was the 240th social network funded. So why Facebook? Well, they had 2 amazing things going for them. Number 1, real names. Other than LinkedIn, everybody else was fake names. You know, Sally Joe 47, fake names. And so you weren't a fake, you're real. The second was their distribution model early on in colleges was brilliant. inclusive in the college, exclusive of all the people with non-EDU addresses. You trusted it more than you would a normal social network. So they were distinct enough, and later they figured out the news feed, and then they took off like crazy. And having been involved with MySpace, we saw them coming up the tailpipe. And once they got where they started, no way could MySpace ever catch up. Its whole structure was fake names. It never could catch up. Its whole model was wrong compared to that. So that's an example where you might be late to the market, but you're so distinct, you had a profound insight, you ran and became one of the great companies. Is that helpful?
A question from the virtual audience. If there's a bubble and it bursts, might this give the rest of the world an edge over Silicon Valley? Should entrepreneurs keep that possibility in mind?
No.
Why not?
He didn't ask that. You added that. The history of bubbles and technology. Hope you don't mind if I go into history. Is that okay? Is Goss, Huns, whatever.
Doing it all night.
Yeah, okay, good. Can't help myself. I lived with the Huns, I've been around a while. So, the history of technology. Detroit was the center of cars, Pittsburgh of steel. St. Louis originally, the center of food, and it moved to Chicago. And Chicago's held it for 150 years. And when you went globalization, the center in Stuttgart and near Tokyo and cars competed very directly with Detroit. It's a shell of itself. But it's a trivia question. What city in the United States in the 1950s had the highest average wages and net worth? Average, not the total. Detroit, Michigan. Amazing how far they've fallen. The point is, technologies cluster, and they maintain the cluster a long time until they get stupid or something changes. Detroit just got stupid. Milan is the center of design, fashion design, has held it for a long time. You get the idea. Silicon Valley is the center. It was competing with Boston for a while. Boston picked the wrong technologies. Silicon Valley won. This center is going to stay the center despite all attempts to knock it off its perch until the core technology foundation shifts. And we shifted from semiconductors to software brilliantly or luckily, one way or the other. So the answer is no way. When we go down, the rest of the world goes down. And when we come back, they'll come back after us.
Question here.
I was, Duncan, I was very interested in your ideas about growth versus profitability. And recently, you're familiar with Solar City. And Solar City has made a decision, rather than to keep their growth extremely high like they've been, to level off their growth, work on their costs, and become cash flow positive, with the idea of in 2017 that the tax credit for solar systems is going to expire. And so it's interesting where you have a company that decides that they're going to scale back their growth and switch toward a profitability model. I was just wondering what you think of that in particular with Solar City. Of course, their stock dived down real big because of that. But
okay, I can answer that, I think. But first, let me step back. I actually didn't say profitability. I said good unit economics.
Well, I meant actually, rather than profitability, I really meant cash flow.
Yeah, but I'm saying all these companies, you're all going to need gobs of money to grow.
Right.
You're not going to escape that. The lean technology, lean startup system is lean for a while. But when you start going up the curve, you end up catching up with the fat system in terms of gobs of money to grow. The amount of capital it takes to get to be a scale company hasn't fundamentally changed. It's just cheaper to get going. Okay? So in that period, you don't get going companies. In that period to get going, you have to be more focused on unit economics, but you still have to grow. So if you're growing on negative and bad economics, you're going to be roadkill. If you can grow on good economics, you can probably get through it. Solar City is a different case. There was a clean tech bubble. There was one in the 80s, and there was another one now in the 90s and the aughts, and they both had the same endpoint. So, story. There was a company called Luz. This is started in 78, 79 out of Israel. They were the best in solar thermal, mirrors in the desert. You've seen all the movies on it. And they had like 90% market share until 91 when the subsidies ran out. They went bankrupt. And they showed up again in Luz 2, and later called a Bright Source in the mid-aughts. and they had a better idea of how to build it. And they built the Ivanpah plant outside of Vegas, which you guys can read a lot about if you're interested. The problem with clean tech is that it's based upon subsidies and laws which require use of the technology. It's not based upon core economics. And they're hoping that the economics get down to parity faster than the subsidies run out. It's a race against that. And who knows if they're going to make it or not. Solar's been subsidized for 30 years. It's still not at parity. It works well where Solar City does it on rooftops, retail. It's arbitraging retail rates. They're not at parity yet in the desert. So Solar City's making the right decision. I don't know if they're going to get past the race. But I'd say that's a specific example. It shouldn't inform you as to the more general, unless you're in the clean tech business or the government regulation subsidy business. The problem with the government as an investor or a supporter in regulation is it comes with a huge cost. There's a reason why venture has put very little money or very few successes in education or medical, core medical. And I know we have, what, you're doing, but the reason is they're so regulated, venture capital doesn't like regulations. They go around the rocks in the river. And these are huge rocks. And so it's been very difficult for the venture guys ever to make any money in those markets, even though they tried. Clean tech worked for a while because it was so subsidized. Subsidies goes away, it's going to be hard. Because you're trapped in a regulatory quagmire you don't want to deal with. Yes, I mean, there are examples. Your example may work. Tiger Tech seems to be working. Yes, there are examples you can make a hay of it. But in general, it's been a difficult place to win. Okay. Do you have a question?
There was a question from one of our virtual audience members. Is this a good time to start a startup? And if the bubble bursts, or when the bubble bursts, is that a good time to start a startup? Well,
I'd love to say start at any time. But I think the real answer, looking at history, Cisco was started in 1984. And the PC bubble burst in 83, and it was too late to get through the window. And companies got out. Lotus and Compaq went public in 84, but they both went from $0 to $100 million in 1 year. Amazing companies. A bunch went public in 86, like Microsoft, but they were around for 8 or 10 years. Oracle. Cisco took a long time before it began getting in, and it caught the next wave. Look at LinkedIn. LinkedIn started in 01. It really didn't take off till 07. So the point is this. History says by far the best time to start a company is in the trough, after the bubble burst. Not while it's bursting, not here, down here. It's sort of a general rule. If you get something started at the bottom or you invest at the bottom, you're in the best position. But you got to last a long time. And so it's a different mentality.
Yeah, I noticed a number of clients that started in 08, people laid off, people that it was sort of nuclear winter for them, that had the possibility, the capabilities to bootstrap, came through it very well. But it's tough. I mean, it's incredibly tough. But there are great hiring opportunities.
Here's what I want to say to the audience and people here. Again, your thing might get out, you might get liquid, you might make a lot of money, you might be happy people, you may miss this thing. Don't worry about that. You just want to get the skill and position. You're going to play the game several times. The guy that did Uber, if you go back to his history, he had some good ones, some bad ones, and a long drought, and then El Nino hit, and he did well with Uber. So you just look at the history of a lot of these people, and they're not just up. Let me step back. Most people rewrite their history. It was all easy, but the reality is it never was easy. Twitter had a hard time raising money. Twitter went to 20 venture funds, couldn't raise a dime, and went to a Boston fund to raise money. Think about that, Twitter. So it's always hard. They rewrite history. Just expect it to be hard. That's part of the fun of this thing, I guess. Fun of the life. But yes, not now, not in 2 years. At the trough point when the next set of technologies emerge, get in early. That's the best place to do it.
To your point, we had Gary Swart, the CEO of Odesk, before he sold the company and went in as a venture partner at Polaris. He said, experience is what you get from a startup when you don't get anything else you want. So to Duncan's point, you may get lots of experience. Any other questions here? Okay.
guess my question with Twitter is, so what was its unique thing? I used to be an inventor. I used to be a principal at a debt fund. We did clean tech. It worked out great. Only the debt guys won. But you mentioned that the way that you get money is that you need to find that unique thing that makes you better than the competition. Most of the stuff that I saw got funded successfully was stuff that was Me Too.
Exactly.
So in order to be successful in funding,
herd animal.
Yeah,
VCs
in
are
order
herd
to be
animals.
successful in funding, maybe to that gentleman's question, it might have been more be a good herd animal. So,
No, but it doesn't matter. It's no good being part of a pack and losing. It's better to take the risk and to fight the battle for something really important. Like, it's just better, like helping the prisoners out or something. That's a more important thing in your life. And it's better to do something a little off scale than to do what everybody else does. Here's what Twitter did. Blogger was, the first company I did was Blogger. And Blogger got bought by Google for a glorious $5 million. Everything, wow, big win. I went to the Blogger party. I have a Blogger t-shirt somewhere. It's kind of fun. And he went on, he said, after blogging, we're going to do podcasting. So his original idea was to do podcasting. And we found that's too hard. Blogging's pretty easy, people do it, but podcasting, you have to have talent. You gotta be a radio talk show host. That was always my vision for myself. I never quite made it. Being a radio talk show host. So you can see, right? So he pivoted. He's a classic pivot. And he said, okay, instead of doing something more complicated than blogging, I'll do something simpler, microblogging. So Twitter started off, it's 140 characters because SMS is 160 and you wanted 20 for the header. That's how he determined the length. And it was meant to be status. Hi, I'm happy. Had a coffee. Really great stuff like that. That's what his insight was. Go microblogging. And it was an incredibly powerful insight. Because we have a whole generation of people that are ADD. And millennials more than boomers, etc., and the centennials, oh my God. So the point of it is, that's his insight. It was profound. There was nobody else doing microblogging. He was unique. And he had cred from blogging. And he still had a struggle. But the win was great. We hope. That help?
no, I just thought it was amusing, just seeing the number of companies funded as a Me Too versus the number that are funded
240 social networks, right? 240 social networks would be different than Facebook. Well, we have a better look.
Is that because of FOMO?
But I would argue also that it means Facebook coming in and saying, oh, we have actual names. I mean, it's, if you don't know for a fact that that's a game changer, it's like, okay, so you have to use actual names, big deal.
That and its distribution model. And then he got lucky or got brilliant with the news feed. Yes, but okay, everybody take this lesson to heart. 240 social networks, MySpace is a big dog, LinkedIn's kind of limbering along, but a lot of roadkill. And you walk in, we're doing what everybody else does, but we have real names, right? And everybody says, aren't these disguised dating sites? How are you going to win? Okay, but he got past that. My point is, fine, let the sheep object and give their normal answer and just deal with it. He obviously had a brilliant answer. He got past it, right? I've had pitches from people, oh my God, this sounds really off the wall, but he makes us think and we work through it. There are VCs out there that, let me say this. I bet if you ask any VC friends, are you guys contrarian investors? Yeah. Right, but they're not. But there are some who are. I mean, Mike Maples invested in Twitter. He's a classic real contrarian. And he looks for exponential type ideas. Peter Thiel, everybody loves Peter Thiel. So Peter Thiel, he invested in Facebook. He's also a guy looking for 0 to 1 and exponential growth and monopolies. He's looking for monopolies. He's looking for the difference. He's not trying to invest with 20 other SaaS companies. So they're out there. One advice that most founders don't follow is VCs are very different and they have different focuses, and individual VCs are more important than the fund. Do your homework. Go find the contrarian. Don't make sure they don't already have Facebook in their portfolio, right? So do your homework before you pitch. Don't try to pitch a lot of VCs. You're wasting their time and yours. Just sort of rifle shoot. Okay?
Just one quick question that it's got nothing to do with the bubble, but you obviously see so many portfolio companies, so many companies coming in the door. Is there any one thing in particular that you see startup entrepreneurs doing that you go, oh my God, I just don't believe they're doing this? Is there anything that you can give to the audience here and watching, just some words of wisdom, stuff to avoid?
Well, we have a couple guidelines stuck on our website. Not that it's a great website, but the guidelines are kind of fun. My favorite, my partner did, is, no, I don't want to see your demo. So the thing is, entrepreneurs coming in and say, you got to see this technology. No, we don't. Well, you got to see it. You say, I'll tell you what, we assume it's the best in the world. Just tell me about your business. And so first of all, if they can't explain their technology before they show it, something's wrong. It's like, I have to see it before I understand it. Okay, then it's probably too murky. But the second thing is, I'm investing in their business. I'm worried about the monopoly they create, the unfair advantage. How are they doing in the real world? What results are going to achieve on my money? Less than I'm worried about, gee, that's really cool. I love your technology. And look, I'm a gadget guy. Look at me, I got gadgets everywhere. Got a Fitbit in my pocket. So, I mean, see my point? That's probably the biggest advice I'd give to people. Most VCs love the technology, and you spend all your time talking about your demo, and you show the demo. And so what? I assume it's great. If you're not great, you shouldn't be here. Like, we're all Donald Trump. We're all great. So you have to be great, right? So talk about your business and talk about your unfair advantage and talk about that and how you go to market. Don't talk about your technology.
Any advice, considering we may be entering bubble land, any advice, to the entrepreneurs watching, listening, sitting here, in terms of what they should really, I know you've mentioned a couple of things, get traction, just, watch your burn. Anything else that you see people doing really dumb stuff, at this stage of the game?
Well, given this is a discussion of bubble, and I actually think we're not in it yet.
But it's looming.
Yeah, but there may be a trend reversal delayed for a year. I mean, given that, don't time the market. If I had to give one piece of advice at that level on the bubble, what the bubble means, don't try to guess the bubble. Don't time the market. You had examples of very storied VCs thinking it was a bubble 2-3 years ago. I know people out there, very, very good funds, who went underground. They had pencils dropped 3 years ago. If you went pencil down in '98, you missed it. All the money that was made, you missed. There are examples of venture funds that got quiet and went pencil down in '97, '98, thought it's over. They missed it. They're not funds anymore. The funny thing about bubbles is, I said, you're in a bubble when they say, I got to do it anyway. That's true. If you stay out of the bubble, you miss it. And, another Wall Street phrase, this is why don't be a market timer is what I'm saying. Another Wall Street phrase, bears make money, bulls make money, pigs get led to the slaughter. Or as J.D. Rockefeller said, I never made money selling at the top. You can't time the top. So if you wait to make money at the top and you miss it, remember, these things drop parabolically. They drop, oil went up to 147 in 2007 and dropped to 31 in 6 months. It took them years to get up, and it dropped. You're done. You can't get out. So don't try to time the market. Don't try to time this bubble. Understand the context when you talk to people like me or other venture people, but don't think about the bubble. Create a real business. Get your business to work. Understand you got to be careful on unit economics. Okay? My advice is, so don't worry about the bubble.
Okay, and I know that you don't have enough deal flow. So why don't you just tell the folks here, Bullpen obviously is a great fund, but you seem to have some very varied investments. So for the folks that may be thinking they'd like to, send something in, what's your sweet spot?
Okay, I'll make the commercial really quick. The group of us have done a lot of startups. I did 4, my other partner did 4, one guy with 3. We just brought our new guy in who's done several. So we have a lot of operating experience. And we started doing angel investing in 2007 together. We did really well. We had Zynga, Marketo, Millennial Media, and it was worth over $1 billion. A company called Tanium and 2Mogul. These are a good group of companies if you know them, but they're back then. In Fund 1, we went a little bit later than Angel. We went into what we call post-seed. So once you get through your Angel or seed round, have some trajectory, and then we invest. Post-seed really means post-product market fit. And in our fund, we have Fanduel and some other aspiring unicorns, kind of a cool fund. Our Fund 2 we're getting a little tighter in our model because we're getting later in this process. So you guys don't time the bubble. I have to. So I'm getting a little bit tighter in our decision making. I think most of you are probably too early for us. So you come to us when you have product market fit, you're growing, and you want somebody like us to come and help you build your business model fit. So we try to take people, and what we're trying to do is take people from, we're kind of an early A round. We're trying to take people from a small post-seed round to a supersized round, 10, 12, 15 million. Our track record's pretty good. I looked in Fund 1, I think 60% of our deals, 57 or 60, went from our post-seed to some whomping big round, 12 or more, at a much higher value. So that's our game. We're trying to skip the 5, 6, 8 million A because sometimes it's more of a trap. So we fit some models, not others.
Post-seed, pre-A.
Well, early A. Mark Andreessen calls it an early A. We're sort of front-running the A round traditional venture people and then trying to pop beyond them.
Excellent. Well, thank you, Duncan. This has been really enlightening. Appreciate you taking the time. Thank you.
Our check right now is $750 normally. The round is 2.5 to 4. When we started, we were doing a little bit less than that, like 600K, and the round was $1.5 million to maybe 2.5. Now the whole industry, seed, back when seed round was 800K to $1 million, now it's kind of crept up to $1.2 million to $1.5 million. Valuations were like 4 pre, now they're up to like 6 or 8. So we're creeping up with them. I think in Fund 3, we're going to be doing more like $1 million, maybe $1.2 million normal size. The rounds will probably be more like 3 to 4 instead of 2.5 to 4. It's just the nature of the business. You see some of these charts, the angel industry is maturing, so we're trying to mature with it. And after the bubble, actually it's kind of interesting. When we first started the fund, we thought of it as a bear market fund. Because what we were thinking is, our experience after the bubble in 2001 was a wonderful time to invest. And a lot of companies come crashing down, but they're very, very good. And so we're kind of a reseed post-seed round. They sort of got orphaned because they're economic or, just got lost in the shuffle, but they're really good companies. So we think we're going to have terrific opportunities to invest post-bubble. We just have to put a little more money in and carry the companies longer. Okay?
Excellent. Thank you, Duncan.
You do.
Yeah. Okay. Thank you, everybody, for coming and for watching virtually. Appreciate it, and we look forward to seeing you at the next one. Thank you.
Thank you.
You guys remember hunting dogs, aren't you?
No,
that was a good one.